Well, what I'm trying to say is despite the image of confidence,
Okay.
and despite the bravado that this stoic personality that is Jerome Powell, who really is just a voice for the FOMC, despite their underlying confidence in what they're doing, there is a track record, a history. Take the Fed forecast with a grain of salt. It has a terrible track record. This, according to another CNBC article from Bob Pisani, one of my favorites.
This is a new thing we're doing for the show now. We're calling out the authors of these articles?
Yeah, I just feel like it's respectful.
It's respectful.
Classy.
Oh, it's classy.
It gives us a little bit of journalistic integrity. And I like Bob Pisani. So
I like that name, Bob.
the other one just had a funny name. Bobby over here.
Pisani.
Bobby's a good guy. So Swedroe noted that at the end of 2021, the Federal Reserve forecast that it would need to raise rates 3 times and that its policy target rate would end 2022 below 1%. Isn't that lovely?
Mm-hmm.
What actually happened, you might be thinking? Well, the Federal Reserve raised the Fed funds rate 7 times in 2022, ending the year with the target rate at 4.25 to 4.5%.
Mm.
How does this happen, Saied? How does this happen?
Okay, tell me.
There are two fundamental underlying problems. Problem number 1, okay? Predictions from the Fed and everyone else are riddled with bias and noise that limit the quality of those predictions, okay? Bias and noise. And what we mean by bias is if you're in the real estate business, we've talked about this a ton on the show, and you're an economist, Lawrence Yun, for example.
National Association of Realtors.
Right? You have a bias because you inherently like and work for real estate and realtors.
Yeah.
You can't control that. It's not intentional. It's emotional. It's subconscious. It is what it is. And the noise, everybody in your ecosystem is going to be, and my word of the day, pundit, is going to be a supporter of that philosophy. And they're going to give you the data skewed towards that philosophy.
Yep.
Problem number 2, lack of complete information because events occur that are unpredictable and can affect the outcomes. And to this, I would say, despite the fact that the Fed has said that they're very data dependent, what data have they really honed in on and relied on that has been so pivotal that they needed to raise rates at the cadence that they've been at?
That remains to be seen.
And it should have been seen by now. Therein lies the irony. I would have had more respect for Jerome Powell and the FOMC if they would have said, hey, look, honestly, we do feel that another 25 basis point may be needed, but we haven't seen the data to support that. Now, do we think that X, Y, and Z will increase? Yes. And if they do, that 25 basis point will be. I understand that they don't want to put themselves into a corner by giving you some type of reference, an index to look at. But at the same time, if you're really looking at those things, what's wrong with being communicative and letting us look at them the same time you are?
Right.
If that's truly what's driving your decision.
Right.
So all of this should make everyone feel very humble about the forecasting, the things you hear from the Fed, and less eager to make sudden changes in your investments. Don't react to what the Fed says they're going to do. React to what you see happening. Yet another reason why we tell people on lives, on the show, all over social media when we respond to questions, the number one question, what should I do with my money? We tell you to wait. People get really, really frustrated because they've been taught their entire lives having money in your savings account is only wasting money. You could be making more money on your money, but you're not leveraging it.
Right.
Not in this market, kids.
And it has been
in this market.
I think it has been proven so far throughout this cycle that, look, the S&P 500, even the NASDAQ, even though it took a little bit of a dip yesterday, it's still been performing this year so far.
Yeah, but we're entering into and seeing already the pains of a cracking system in an earnings recession. To continue on the article here, the key to investing is to know your risk tolerance, have a long-term plan, stay invested, and avoid market timing.
Yeah.
Now, I will say there's a little bit of beef I have with that statement, but I'll get to that in a minute. Swedroe's conclusion, if the Federal Reserve, which sets the Fed funds rate, can be so wrong in its own forecasts, the people who are supposed to be the subject matter experts, who are the ones driving the decisions, if they can be so wrong in their forecasts, it isn't likely that a professional forecaster will be accurate in theirs. The Lawrence Yun over at the National Association of Realtors.
Mm-hmm.
Logan over at Housing Wire. Great guy. I like him. Okay. But even the guys at the higher standard.
Come on now.
We are not better than these people. The only difference and the reason why we think we can see some of these things and have a great track record for calling these things thus far.
Mm-hmm.
Well done, by the way.
Yeah. Good job.
It's impressive.
Kudos.
I mean, I will rub those fuzzy fingernails all day
There you
long.
go.
The reason why is we don't have an inherent bias. It doesn't matter to us one way or the other. And we're very clear with the banking background and what that means for us. But the fact of the matter is we started this show to provide financial literacy. We don't have a reason to push you into one investment or another. We're not selling you anything, at least not yet anyway. And we don't have a reason to financially motivate you one way or the other. We hope you do what is truly best for you. And right now, despite popular belief, you'll hear a lot of this. The key to investing is to know your risk. Excuse me, I sound like Saied. Know your risk tolerance, have a long-term plan, stay invested, and avoid the market timing. I agree. It's almost impossible to time the market in some instances. However, yes, stay invested. But let's say you're holding a large amount of your assets in a company that's at a very high point. Maybe you sell now and go to cash and wait and then go back in the market when things dip a little bit more. Maybe. It's not always the case. And what I'll tell you is dollar cost averaging, buying consistently through any period of time is a great strategy, one I absolutely believe in. I know one you believe in.
That's one that we practice.
Yeah. There's nothing wrong with that. What I will say is there are red flags in markets. If you got the NASDAQ at an all-time high or close to all-time highs in some ways, and you've got all these companies with massive earnings, and you know consumer spending is going to pull back, and you know you're seeing cracks in the system, then I would say, why don't you be thoughtful about investing in those particular markets and wait?